I want to have a discussion now on the potential risks. Nigel, you also touched on some of the potential risks with respect to price movement. The fact that interest rates are going up now in the market suggests that the price for the bond, there will be downward pressure on the prices for the bonds, and such that anybody who wants to sell on the secondary market after they're issued, there is a chance that they can face a lower price than they paid for. Now, there are other risks that were outlined in the prospectus, which I believe everybody needs to read and everybody needs to get a proper understanding of what these risks are: market risk, interest rate risk, credit risk, and so on. I would just want to hear from you both. What do you think are the more serious risks facing any investor with these bonds?
Well, the point is that the bonds are secured by a debenture over the equities. And the dividend streams, as Brent pointed out, are sufficient to cover the interest payments without a problem, leaving about 109 in a worst case scenario where you have no 5 years issued and you only have 12 and 20-year issued. You would have about $119 million a year going towards the principal payment. If you take that $119 million and invest it at a return of 2%, you would end up with about $2.9 million at the end of 20 years. And if you get 2.5%, you'll end up with $3.1 billion. So at the end of 20 years, you would have to look for another half a billion dollars, assuming that the investment is not rolled. That's not a huge amount. And remember, again, you have equities backing the investment. So for me, as Brent says, you have a really good investment, well secured, and as he said, I really don't see the risk, and as you said, there is always risk. So let's talk about price risk. If the price drops, what that means is that your return will drop. If you have invested in the 5-year bond at 4.5%, after tax you're looking at 6.43% if you're in the 30% bracket, as most of us are, then your return may drop to maybe 5% after given the tax effect. So is that a risk that is unreasonable? Is that a risk you want to take? I would. And therefore, that's how you have to consider the investment. So the price that you will get if you cash in early, cash in before maturity, would depend on the interest rates available to similar investments in the market. Therefore, at that point in time, you have to decide what would be the impact on my return and make your decision based on that. But so it's not that you're going to lose, it's that it impacts the return on your investment.
Okay. Yeah, but with regard to the culture in Trinidad, bond trading is not something that is on everyone's to-do list. Yes, we don't trade bonds very often. Even institutions don't trade bonds very often.
We buy and hold, right?
That's correct.
Like so land.
So exactly. So the market risk and the price risk is something that market risk is probably the biggest risk in the sense that the underlying assets trade on exchange and are exposed to swings in the exchange. So when the exchange, the market falls, the asset value will fall, the collateral value will fall. Right, so you have that risk. But in terms of the bond itself, interest rate risk, that only applies if you're going to sell the bond, which I said hardly likely. There's liquidity risk, the ability to actually trade it on the exchange. And again, given the lack of a trading culture in Trinidad and Tobago, that really wouldn't really be taken into consideration. And interest rate risk, which Nigel touched on in the sense of when interest rates move, in this case, when they increase, the price of the bond will fall. So, and that only applies if you're going to sell. So really and truly, the only risk that you're going to look at is default risk, and we've covered that in the sense of adequate coupon coverage, sinking fund to address the principal payments, and additional bonds could be issued for any shortfall.